Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers. And thanks so much for joining today's presentation that is being brought to you by GreenTraderTax. I'm very pleased to have Robert Green deliver today's webinar. So with that, Robert, what I'm going to do is pass you over the controls so that we can go ahead and get underway here today. Thanks for joining us, Robert, and thanks for today's presentation. All right, now you have the controls. If you can do your screen share, we'll get underway.
Great, thank you, Cynthia. Okay, let's get started. Today's event is how the Tax Cuts and Jobs Act impacts investors, traders, and investment managers. Everybody knows about the new tax law. It got a lot of fanfare. There are winners, there's losers. Investors could be a loser on some fronts, but could also have some positive things as well. The biggest problem is no investment expenses. Traders, for the most part, keep all the great benefits they had before and have even more now. Investment managers have some modification to carried interest and the like. So I'm the presenter, managing member of G&M Trader Tax and CEO of GreenTraderTax. And our trading is a real profession, and other tax professionals and solution providers underserve them. We focus on traders. I am a leading authority on trader tax. I just finished publishing last week Green's 2018 Trader Tax Guide. That edition discusses the Tax Cuts and Jobs Act impact on investors, traders, investment managers, and everything else about the trader tax benefits. So it's a must-read for our clients. I'm an ongoing contributor to Forbes.com, and leading brokerage firms and other financial media use our content. I'm frequently interviewed in all the major media, and you'll find me as a speaker at the Traders Expo. Come see me in New York City next month. This information is educational. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Where specific advice is necessary or appropriate, you may wish to consult with a qualified tax advisor, CPA attorney, financial planner, or investment manager. And I, Robert Green, and the Green Companies are not affiliated with Interactive Brokers, but we have this nice relationship where I'm doing a lot of webinars pretty much every month for IB, and it's become our spot for webinars, so it's a nice combination. Now, when I speak to a group like you, when I write, I'm advising the trader everyman. I am your advocate. I fought to get some of these tax cut benefits for you. I protect you with the IRS. But each one of your cases is different. So I do suggest that you consult with me to get specific advice tailored to your needs. Today, we're going to talk about the Tax Cuts and Jobs Act. The act impacts investors in many ways, some negative, others positive. Investors are upset about losing the investment expenses. That's a big one for them. Traders, they have business deduction expenses. They're good on that front, but they heard about the new 20% deduction on pass-through qualified business income. They heard about the C-Corp 21% flat tax rate. And they're saying to themselves, hey, can I get 21% instead of 37%? Can I get a 20% deduction, which brings me down to from 37 to 29% in effect? Am I going to miss the boat? What do I need to do to restructure to take advantage of that? There's a lot of anxiety out there because the media keeps saying that, you know, high-priced accountants are showing their clients how to navigate the new law to get all these benefits, and you don't want to miss the boat. Now, one thing people are upset about is that the new law suspended or trimmed several cherished tax deductions that individuals count on for savings. They, of course, say that they lowered your rates to offset the, you know, suspending many deductions. So exactly how bad is it and what can you do about it? I'll show you that today. So let's start. I broke this down into different sections. Let's start with the investors. People at Interactive Brokers, you're investors, you're active traders, you're investment managers. The act impacts you in some negative and other positive ways. Here's the big one. Investment expenses are suspended. I don't use the word repeal, Because remember, these individual changes are from 2018 through 2025, and the Act sunsets under the Byrd Rule. So everything goes back to the way it was pre-Act, unless Congress extends it with a fiscal cliff like they did at the end of the Bush tax cuts, and that's probably expected. So I say suspended, but you may as well think for now it's almost like repealed. All miscellaneous itemized deductions that are subject to the 2% floor under present law. These include investment expenses. So when you go to prepare your 2017 tax return, you have your investment expenses, your dues, your publications, your investment advisor fees, your other expenses. Education is not allowed as an investment expense. Home office is not allowed as an investment expense. Trading business expenses are far, far better than investment expenses, but you did have some, and you would deduct it if it was more than 2% of your adjusted gross income. And then if you were in the AMT zone, it got wiped away. So, and then there was a piece itemized deduction limitation. So effectively speaking, a lot of your investment expenses in 2017 are wiped away. But now there's just a clean slate for 2018. They're gone. Now, investment expenses include trading expenses when the trader is not eligible for trader tax status. This is a big one. Stock borrow fees. If you're a short seller, you really get hurt by the Act because you have these large stock borrow fees. They're investment expenses and your related short selling costs, not interest, but your related short selling costs. If you don't have trader tax status, you're not getting a deduction. That's going to upset your model. Now, suppose you have a fancy investment advisor and you're paying them management fees, you're paying incentive fees. You have an outside managed account. All of that's not deductible anymore for 2018. TTS traders, trader tax status traders, they have business expense treatment. Ever since I started Green & Company in 1983, it was all about getting people on Wall Street to set up businesses to have deductions from gross income rather than puny itemized deductions. Well, we're there again. So qualification for trader tax status is more essential than ever. Go back to some prior webinar recordings where I show you how to be eligible and qualified for trader tax status. Now, there may be some family offices on the call today. A family office refers to a wealthy family with substantial investments across multiple asset classes. Well, you could be a budding family office on your own. You have a significant investment portfolio, you're a trading business. A family office usually hires staff, leases office space, and purchases computers and other fixed assets for its investment operations. You're talking about big bucks. They have $500,000, $1 million overheads. A family office produces investment income, and the majority of its operating costs are investment expenses. Uh-oh. Losing the investment expense deduction comes as a shock to them. You can't believe these calls I had. It was really painful over the last few months. Getting a call from a family office, they have $1 million overhead. They don't have any way to deduct it. Now, some family offices are evaluating which activities might qualify for business expense treatment to convert non-deductible investment expenses into business deductions from gross income. It matters now. They're spending the money in January 2018. This is on their 2018 tax return. Now, some of those family offices investing in securities and 1256 contracts, futures, they might ring fence an active trading program into a separate TTS trader tax status entity for business expense treatment. Other family offices invest in rental real estate. That's a business which might have which does have business expense treatment if it's rental real estate. The goal is to allocate general and administrative expenses to business expense treatment. So they have a chunk of retirement assets, taxable assets, investment activities. They have to rejuggle, restructure in a reasonable manner to get more deductibility than lose deductions. Now, investment interest expenses are retained. That's good. The present law remains in effect for itemizing investment interest expense. Investment interest expense is deductible up to the extent of investment income. So if you have dividends, interest, capital gains, and then you have interest, on Form 4952, you have that deduction as an itemized deduction. Now, if you don't have enough income to offset it, it's carried over to the subsequent year. So this remains in effect. That's good. So investment interest expense is different from investment expense. Short sellers. If a short seller does not qualify for trader tax status, the stock borrow fees are considered investment expenses. Now be very careful. Some brokers use the term interest charges when in reality, these expenses are stock borrow fees. I had a whole blog post about that, and maybe I'll do a webinar on it as well. Short selling, how to deduct stock borrow fees, because some brokers conflate it, and that takes on even greater importance now. Now, the new act did modify the interest expense rules. They gave full expensing to corporate America. They let them write off everything. They don't want them to also deduct the interest on buying those items. It's double dipping. They were very careful in the tax cuts. So if they give you a big benefit over here, they don't want you to double dip over there. So according to the new law, the conference agreement follows the House in exempting from the limitation taxpayers with average annual gross receipts for the 3 taxable year period ending with the prior taxable year that do not exceed 25 million. Traders are small businesses. Now, usually when you see the term gross receipts and you translate it into trading, you're talking about trading gains, margin, net trading gains. You're not talking about proceeds, because even a small trader can go way over 25 million of proceeds. We're talking about trading gains. So for the most part, a trading company will likely not trigger the 30% income limitation on business interest expenses. So they don't want you to deduct this large interest if you don't have income. They're putting on, a cap in a sense. Now, this is the big one for investment managers, so listen up. Carried interest modified for managers. You remember President Trump on the campaign circuit said he's not going to take care of his hedge fund buddies, that they're going to have to pay the tax man. New York State is thinking about a new tax for, carried interest. Carried interest has been the boogeyman a long time. If I have a father and son trader or a mother-daughter trader, and the parent puts up most of the capital and the child gets a profit allocation, that's carried interest. That's basic partnership law. That's been around forever. So when they say they're going to just change the law to affect the hedge fund big billionaire, they're going to hit the small startup as well. So I've always defended carried interest on legal grounds. I'm not defending billionaire tax breaks, but I'm defending it for our clients. Now, the new law changed the carried interest tax break for investment managers. I'm talking about the managers, I'm not talking about the investors right now. So lengthening the holding period on profit allocation of long-term capital gains to 3 years from 1 year. So if you're a hedge fund without trader tax status, you're buy and hold Apple stock, Google stock, and you hold it for a year, your investors would get a long-term capital gain, and you would get a profit allocation, a share of their long-term capital gains, a share of their interest, a share of their dividends. You're basically getting a share of what they get. You're in the same boat. But now it's different. Now the partnership prepares everybody's K-1s, and if it's held more than 12 months, the investor gets a long-term capital gain, but not the manager. The manager has to hold a position for 3 years. This doesn't affect our active traders. They weren't holding for a year, let alone 3 years. This will affect private equity as well. Now, the 3-year rule only applies to the investment manager's profit allocation. So the investment manager may still have a capital interest, and that would be like any other investor, because they may put up some of their own money as well. So remember, investors get still the same way 1 year, but the manager 3 years. Now, why didn't they just repeal carried interest? Because of the following. Carried interest also helps the investors. This would have been a disaster had they changed this too, because remember, they said to the investor, you can't deduct incentive fees and management fees. So if your fancy hedge fund charges you 2 and 20, You can't deduct the 2 and 20 as an investment expense. So this is where carried interest helps the investors. Had the new law repealed carried interest outright, investment partnerships without trader tax status would be stuck passing through investment advisory fees, including incentive fees, on Schedule K-1 as a non-deductible investment expense. So if there's trader tax status, it passes through line 1 ordinary loss. But if it doesn't have trader tax status, it would have to pass through investment expenses. Carried interest fixes that. The partnership allocates capital gains to the investment manager instead of paying incentive fees. The investor winds up with a lower capital gain amount versus a higher capital gain coupled with a non-deductible expense. Here's an example. Your investor gets $100,000 capital gain and a $20,000 non-deductible expense. They pay taxes on the 100. They can't deduct the 20. Ouch. Wouldn't it be better to give them a capital gain of 80? So in effect, the expense was reduced from the taxable capital gains? Of course. Now, this was a scare. You remember, they said, oh, we're going to require FIFO, first in, first out on the sale of securities. If you bought Apple 5 years ago and you sell it, you got to sell the Apple with the old low cost basis. You can't sell the one you just bought this past month. You're going to have to use FIFO. That caused a huge uproar, blowback, and Congress listened, and that scare went away. They did not require it. So keep in mind, FIFO is the default method. But sellers of securities may also use specific identification. You can say, no, I'm not selling Apple that I bought 5 years ago. I'm selling Apple that I bought last month. So I have a smaller capital gain. You know, it's risen a lot in the last 5 years. And so we have people who come to us for taxes and say, that's what I want to do. And so we say, well, show us your contemporaneously written instruction to the broker and a written confirmation of that execution by the broker, because that's what specific identification requires. For sales of financial products other than securities, specific identification may not even be possible. So don't just throw around these accounting methods willy-nilly. There are very specific rules on how you may use them. FIFO is a default. Now, if you're an active trader or day trader, none of this means anything. And of course, you're probably using Section 475 mark-to-market accounting. And if you're trading futures, it's MTM mark-to-market is built into 1256. But for the buy and hold investor, this is important stuff. Now, investors have always gotten one great benefit in the tax code, and this remains: long-term capital gains rates are retained. The new tax law maintains LTCG, long-term capital gains rates of 0% if you're in the lowest brackets. That's why if you finished 017 and you left the job the year before, you didn't have any income, you didn't want to do tax loss selling, you wanted tax gain selling to take advantage of that 0% long-term rate. 15% in all the other brackets except the top bracket is 20%. And they kept that. 018, 017, except for one little glitch in between one bracket, it's basically the same, the 018 and 017. They didn't want people gaming the system to rush in sales or delay sales for that. So long-term capital gains rates apply if an investor holds a security for more than 12 months before the sale or exchange. You buy Apple, you hold it 12 months, you sell it. Your tax rates might be almost half. The new tax law did not change the $3,000 capital loss limitation against other income or capital loss carryovers to subsequent tax years. So you have capital gains of 50, you have capital losses of 60, you have a net capital loss of 10. You're limited to 3,000 against your other income, and you carry over 7,000 to the next year. The next year you make 10, you soak up the whole 7. Capital losses are unlimited against capital gains. They're only limited 3,000 against other income. For that benefit, Congress has added so many sticks. For the one carrot, they've hit you with so many sticks. The capital loss limitation, the carryover, the wash sale loss rules. So that's where they make you pay for that benefit. A lot of active traders, they don't get the long-term capital gains rate benefit, so they want the trader tax status. So the new law also retained the lower long-term capital gains rates on qualified dividends. That's where you hold your common stock for 60 days and you get the qualified dividend. Now, interestingly, Section 1256 capital gains rates are retained. The 60/40 capital gains rates on 1256 contracts are intact. Remember, 60% is a long-term capital gain, 40% is short-term, even on a day trade. When you do the math at the maximum tax bracket for 2018, the blended 60/40 rate is 26.8%. That's 10.2% lower than the top ordinary rate of 37%. For 2017, the top rate was 39%. The blended rate was 12%. It was 12% less. This is like 1/3 off almost. And this blended rate is significant throughout all the brackets. So no matter what income level you're at, you get tremendous savings trading Section 1256 contracts. Now, the new law did not mention any changes to Section 1256. So you just open up the act. Here's how we do it. You open it up, you search a code section, and you see when it's every time it's brought up, and you read that when it's what it says, and you see if it made a change that's important. 1256 losses can be carried back 3 years only against 1256 gains. I'm surprised they didn't rein that in, because they did say no more NOL carrybacks unless you're like a farmer. But so 017 can be carried back, but 018 NOLs are repealed. They can only be carried forward. Capital losses are carried forward on securities. So 1256 has this break still. And it looks like also for carried interest, if you're a manager of a futures fund, you're getting the benefit of the 60/40. There's no 3-year rule there. Now, these wash sale loss rules are a real pain in the neck for investors, active investors. If you just buy and hold and you don't have much activity, you don't really trigger that many wash sale loss rules. But if you buy a lot and sell a lot, if you take a loss and 30 days before or after you bought back a replacement position, a substantially identical position, you can't take the loss. You have to add the loss to the cost basis of the replacement position. And if it happens at year end, you're deferring a loss to the next year, which can raise your taxable income and tax liability. If you trigger the loss, wash sale loss with an IRA, including a Roth IRA, it's much bigger than just a year-end problem. It's a problem all year long. You can't take the loss in your taxable account, and then when you go to add it to the cost basis in your IRA, there's no way to do that. So you permanently lose the loss. I wanted Congress to fix the wash sale loss rules. It's crazy on how it's applied to active traders. We've always had a simple fix, which is, hey, qualify for trader tax status, elect 475, you're exempt from it. Bingo. But a lot of people don't qualify for trader tax status, or they can't right away elect 475 because maybe they have a large capital loss carryover. Of course, then the wash sale is not a big problem. If you have a capital loss carryover, you can absorb a little phantom income. So the new law does not make any changes to 1091 wash sale loss rules. It does not make any changes to 475 MTM ordinary income or loss. That's the tax loss insurance for the trader tax status traders to be exempt from wash sales, exempt from the capital loss limitation, to have that full business ordinary loss protection, and now also qualified business income for the 20% pass-through deduction. So none of this stuff has changed, wash sales in 475. The new law also does not change tax treatment on various financial products, including spot forex in Section 988, ETFs, ETNs, volatility options, precious metals, swap contracts, foreign futures, and more, untouched. This changed. Section 1031 like-kind exchanges are restricted to real property. Most of you IB traders are not doing 1031 in connection with your trading, but some cryptocurrency investors were, and now they can't do it anymore. Investors may no longer use Section 1031 to defer income recognition on exchanges in artwork, collectibles, and other tangible and intangible property. Clean slate, you can only do it for real property. Securities were never allowed to use 1031. You can't say I'm exchanging Google for Apple in a tax-free exchange. Now, the new act did not change Obamacare, and net investment tax is retained. Remember, the Republicans wanted to repeal Obamacare, and they had a whole bill about that. Funny enough, that bill did not repeal the net investment tax. It's funny, when Congress gets their hands on some nice revenue from individuals, it's pretty hard to get it out of their hands. You remember the 2.9% Medicare tax on your wages that's unlimited? That was left over from Hillary Care in the 1990s. They never passed health care, but they kept that tax all these years. So that failed bill didn't repeal it. This tax cut bill didn't repeal it. The new law retained the Obamacare net investment tax of 3.8% on net investment income over modified AGI, adjusted gross income, of $200,000 single and $250,000 married, and they don't even index it for inflation. The act, I think they just, the way they make changes to the tax law, sometimes they just say this whole code section is gone. So remember, investment expenses, they said all miscellaneous itemized deductions, gone. But they didn't say that they were suspending miscellaneous investment expenses, investment interest expenses, state, local, and foreign taxes for net investment income. So you might have lost a deduction on Schedule A, but you didn't lose that deduction on Form 8960 when you calculate your net investment income. So continue to keep track of those costs and give it to your accountant. Maybe they'll clean it up in a technical corrections bill, but it's still clear sailing on that right now. And by the way, that's worthy of mention. This tax act was done in haste. They had to get it done fast. It was a huge thing. Obviously, a lot of things weren't thought out that well, and there's a lot of confusion, especially on that pass-through 20% tax deduction. There's going to be a technical corrections bill. There are going to be IRS regulations, IRS guidance, cleanup issues. Some of this stuff is going to be a moving target. So what you see today could change a bit tomorrow, so stay on top of it. Now, the biggest change from the Tax Act is the ordinary tax rates are reduced across the board. So yes, you can decry the loss of this or that or the other, but you do get reduced tax rates across the board, and that is going to give you some benefit when you do crunch the numbers. So you have to look at the filing status. They made some changes, but look at the new brackets. Now, the top rate was reduced from 39.6 to 37%. And that's kind of indicative of the changes throughout the brackets. Short-term capital gains are still taxed at ordinary rates. See how we're doing on timing, pretty good. Repeal of the recharacterization option for Roth IRA conversion. So let's say in 2017, before they passed the tax cut, earlier in the year, you thought it was a good idea to do a Roth conversion. You have an IRA, you had an IRA with $500,000. You realize, hey, I'm in a low bracket this year. I left my job. I want to soak up some of the lower rates. I'm going to bust up the IRA. I'm going to do a Roth conversion for $100,000, check out of the restaurant, pay taxes on ordinary income on that $100,000, put it into a Roth IRA. And if the market takes off from there, which I thought it would do at the beginning of the year because, Trump was just elected, and all of a sudden the markets were acting very positive, I'm going to grow that money in the Roth tax-free for life. When I take the money out in retirement, it will not be taxable income. Whereas in my traditional IRA, it is taxable income. So you made that move. But you did it because you knew you had a reversal option. You could recharacterize it. If you made a mistake and the markets dropped in value, then you would beat yourself up saying, hey, I paid taxes on 100,000 to convert, but now that 100,000 is worth 50. Boy, do I feel silly. I want to reverse it. I want to just recharacterize it like it never happened. You can still do that for 017 conversions. But if you do a conversion this month in 2018, they took away that reversal option because they don't want people gaming the system. So 017 is the last year to do the reversal. So that's the investor section. Now we're going to move on to the pass-throughs. So if you're an active trader and you can have trader tax status, you might want to position yourself to get this benefit. If you're invested in your brother-in-law's small business firm, architectural engineering firm, or startup, if you're active, non-active, passive, if you're an investor in any small business, open your ears. You might not have trader tax status, but you might be an investor in a hedge fund. Any pass-through business that you're an investor in, you might get this benefit. This is a huge new area of the law. When they said tax simplification, tax reform, I guess they didn't do that with this code section because this is a huge new monstrosity of tax law that is going to keep accountants really busy. So the new law it's modeled after the old section 199. They call it 199A. It allows a 20% deduction on qualified business income in pass-through entities subject to many conditions, haircuts, and thresholds that will drive you and your accountant crazy. Really smart accountants are trying to get their hands around this deduction, and there's so many inconsistencies and open questions that they're pulling their hair out of their head. I've done this for our trader clients because that's what it applies to the most. So it's a 20% QBI deduction. So listen, if you go to your accountant and you say, I made 100,000 in this business, and they've taken away all these other deductions that I just went through, or I'm actually going to go through at the end of this session. Well, they took away the investment expense, let's say. Well, they replaced it with this $20,000 deduction for you, 20% of $100,000. Of course you want this deduction. It's an above the line deduction, so to speak. It's not an adjusted gross income deduction, but it's effectively from gross income. So this is what the new law states. And if you can figure it out just from this page, good for you. An individual taxpayer, so it's assessed on the individual level. So your K1 that you get from whoever you get a K1 from, it's in play. Don't discount it. It's in play. There's going to be new information on that K1 that you're going to feed into your tax software, and hopefully the software is going to figure this all out for you. And I'm sure it will by this point next year. So it's on the individual level. You might get a huge deduction. Your buddy may get nothing, or vice versa, because it's dependent on your individual taxable income in some cases. So an individual taxpayer generally may deduct 20, generally, thank you. You know you're going to have a problem with that word. May deduct 20% of qualified business income. Oh, it's got to be qualified? What does that mean? Business income, there is no definition of business income in the tax code. From a partnership, S corporation, or sole proprietorship, so your unincorporated businesses, as well as 20% of aggregate qualified REIT dividends or real estate investment trust. So that's in play too. Your qualified cooperative dividends and your qualified publicly traded partnership income. There's a lot of stuff in play here. A limitation based on W-2 wages paid. So the business, it's a pizza restaurant. They have a lot of wages, so that's good. They want to subsidize labor-intensive businesses that hire people. That's what they're trying to do here. That's Tax Cuts and Jobs Act. That's the connection. So W-2 wages paid is phased in above a threshold. Oh, what's this threshold of taxable income? Well, if you make a lot of money, you're going to get little. If you don't make a lot of money, you're going to get help here, because they're not trying to give the tax cuts for rich people, upper income folks. They're trying to target it to the middle income. A disallowance of the deduction with respect to specified service trades. Trading is a specified service trade. Investment management is a specified service trade. Consultant, specified service trade. So right away, you're going to get a lot less benefit as a specified service trade. So a disallowance of the deduction with respect to specified service trades or businesses is also phased in above the threshold amount. All right, so do you know what this means for you? Not yet. The taxable income threshold is $315,000 married. The Senate bill, it was $500. The House bill, it was like $112. They met in the middle, $315 married. Taxable income. So if you and your spouse make $400,000, but your itemized deductions take you under $315, bingo, you get this 20% full deduction. But let's say that you in the tax code, you can't just have a fiscal cliff 315 and then at 316 you lose the whole thing. There's got to be a phase out range. The phase out range is 100,000 married. So if you make, if you make 400,000, you're just below 415, you're going to lose more than 80% of the benefit. It phases out in a logical way. If you're single, it's 157.5. So bottom line, if you're a trader, it's a trading your service business. If you have 475, it's ordinary income. If you tell me, Bob, I'm going to make 100,000 next year, including my trading gains, and I'm going to have that whole 100 is going to be in 475 ordinary income, bingo, you're going to get that $20,000 deduction on the 100. But if you say, Bob, I'm going to make 300, I'm single, I'm above the 257,500 phase out because it's 157,500 for other taxpayers single, plus the phase out of 50, it's 207.5. So when you work with me in a consultation, we're going to go over what business you're in. Are you a service business or not? Service, you just got to be under the income threshold. If you're non-service, you can go above the income threshold, but then the wage limitation kicks in. And I'll go over that in a second. As an example, a securities hedge fund is eligible for trader tax status. With the 475 ordinary income, it may have qualified business income. A lot of hedge funds said in the past, I don't want 475. I have these trades. They morph into profitable positions. I let my profits run. Then I defer it at year end. I don't want mark to market and then clients asking me for a distribution when I haven't even sold the position. I don't want 475. I don't care about the tax loss insurance. That's not my problem. That's their problem. I don't make losses anyway. So they just said, I don't want 475. Now they may want 475 because it could give their investors the 20% deduction. One investor may have very little income and get the deduction, although it's doubtful if they're accredited investors, qualified clients. Most of your investors are probably high tax income and won't get this deduction. But I'm not so focused on hedge funds. I'm more focused on the traders, although I'm helping the hedge funds too. Now, if a non-active limited partner of a hedge fund has taxable income under 315 married or 157,500 single, they might get this deduction in that hedge fund. Now it's on the lower of QBI or taxable income less net capital gains. There's a lot of haircuts, a lot of thresholds and limitations. I could spend a whole session just on that. So we have to move forward. If the 100,000 married, 50,000 single phase out range, if you blow through that, the deduction is fully phased out. So a passive investor in a non-SSA, so if you're an investor in your brother-in-law's restaurant or your friend's startup, or you're an angel in a pass-through startup. Well, they may not have a lot of income, but you could be eligible for the 20% deduction subject to, so this is, remember the 315, 157, and then the 150, the phase out range. If it's a service business, you're either under or you're either over. There are no wage limitations to worry about. You're either under and get something or over and get nothing. But if it's a non-specified service business, all your other types of businesses, then there is no so-called taxable income limitation that rules it out for you. Once you get above that same limitation threshold, so the same 315, 157.5, then it all comes down to, well, does this business have enough wages that they pay? Does this company pay enough wages to give me a good, juicy deduction? And there's an alternative wage limitation, 25. So there's two wage limitations, 50% or 25% plus 2.5% of qualified property. That's the one where everyone got upset with Senator Corker and some of the other senators. That's the so-called real estate benefit, because a lot of real estate companies don't have a lot of wages. They were going to lose out here. So they added this qualified property factor, which the House had in their bill. That wasn't out of the blue. Again, I don't want to lose you in the weeds. So this is for active, non-active, and passive owners. Bottom line, if you get a K-1, is it coming from a specified service trade or is it not specified service trade? And then just apply your limitations and you can do your planning accordingly. If you're a trader, you know your specified service. If you're an investment manager, you know your specified service. So it just comes down to the other things that you need to do. Now, let's focus on a TTS trading company. And I'm sorry I might have lost some of you on the last few slides. Go back and read my blog post, read the guide on it. Let's focus on a trader tax status trading company. What should you do? Now, listen up. You're the active trader. What should you do? For 2018, a TTS trader should consider a partnership or S-Corp for deducting your business expenses, not getting stuck with investment expenses. And you should consider a 475 election on securities only. So you retain 60/40 on 1256 contracts. You want the 475 for the tax loss insurance, the exemption from the wash sale losses, and the ordinary loss treatment. So there's no 3,000 capital loss limitation. That's what you want to do. Now, you want to consider an S-Corp for employee benefit plan deductions, including health insurance, could be $1,000 a month, $2,000 a month. You want a deduction. And you also want a high deductible retirement plan deduction. And you need the S-Corp because the spousal partnership or the sole proprietorship cannot achieve these employee benefit plan deductions. Consider this the cake. This is the cake, the pre-act cake that you want to go for. And it puts you in position to potentially qualify for a 20% QBI deduction on Section 475 or Section 988 4X ordinary income in a TTS trading pass-through entity, the icing on the cake. It's hard to tell someone to do all that just to get the icing on the cake, because suppose your income is too high and you have a great year. So this works out great. You do the pre-act strategies, the business expense, the tax loss insurance, the employee benefit plan deductions, the cake. And if you married and you have taxable income of under 415K, you're going to get some 20% QBI deduction. Under 315K, you get the full 20% QBI deduction. But let's say you hit a home run, you have a great year, you're over the income threshold. Well, you lose the icing on the cake, but you do great with the cake. So that's how I've done this, the cake and the icing on the cake. The specified service activity, if it's under 315, we went through this already, you get it. And then the phase out range, we covered that. Now, Qualified business income. That's what this deduction is on. You need qualified business income. It includes ordinary income. Remember, the code does not have a definition of business income. QBI, qualified business income, likely includes Section 475 ordinary income, Section 988 ordinary income, and it likely excludes business-related capital gains, including your 1256 contracts, cryptocurrency, capital gains on securities. Now, the Act specifically excluded investment-related short-term and long-term capital gains. I think it's fair to say that all capital gains are excluded, even for a TTS trader. Now, it didn't say specifically that 475 ordinary income is included, but we've done an exhaustive look at it. I've consulted with tax writers who wrote 475 code section itself. Read this blog post at the bottom of the page, how traders can get the 20% QBI deduction under the new law. Now, I think it's going to be a challenge for the sole proprietor traders, technically allowed, but a challenge because they have their expenses on Schedule C. There is no income on Schedule C. The trading gains with 475 are on Form 4797, and the IRS may not take that in through the computers. So stay tuned on that. We prefer that you have, if you just want this benefit, the partnership, but if you want the employee benefits, the S-Corp. That concludes the pass-through section. Now let's move on to C-Corps. Let's see how we're doing on time. So we're on slide 32, and it's all right, we're a little behind schedule, but we're going to go a little late, which we tend to do anyway. So we did the investors, we did the pass-throughs, now C-Corps. How to decide if a C-Corp is right for your trading business. Why a C-Corp? No one ever talked about C-Corps for traders before. Well, when taking into account the Tax Cuts and Jobs Act for 2018, a lot of people have seen one major message. There's a 21% flat tax rate on C-Corps versus a 37% top rate for individuals. That's 16% different. Won't a lot of unincorporated businesses want to incorporate as a C-Corp to take advantage of a 16% lower tax rate? Yes, many people are interested in that, but there's a lot more to it. Don't focus solely on the federal 21% flat tax rate on the C-Corp level. There are plenty of other taxes, including capital gains taxes on qualified dividends, double taxation. You're paying taxes on the C-Corp entity level, paying a qualified dividend to get that lower long-term rate, but you're paying a second time on the individual level. Double taxation is obviously could add up to be more than single taxation. And don't forget, state corporate taxes in 44 states apply. That's most states. And there are some other taxes that you never even heard about, like the accumulated earnings tax assessed on the excess retained earnings. So you say, Bob, I'm going to pay 21% on the C-Corp level. I'm not worried about double taxation because I'm going to leave the money in the C-Corp. I'm going to keep reinvesting it. The IRS is going to hit you with a 20% accumulated earnings tax, forcing you to pay qualified dividends in most cases. The C-Corp and related taxes, when you add it all up, it might be considerably higher versus trading in a pass-through. And of course, you might get that pass-through 20% deduction. But I'm saying it's going to be higher in most cases, even without the 20%. So you can say, Bob, I make $1 million a year. I'm not getting the 20% pass-through on my trading business. My income is way above the $415K married. So I want to go for the C-Corp, and I'll retain the income. I'll go through it with you. We'll add up the taxes, and you'll probably conclude in the end it's a mistake. When a C-Corp pays qualified dividends to the owner, double taxation occurs with capital gains taxes on the individual level. Well, it's 0% in the low income level, but it then jumps up to 15% and then 20 in the top rate. That lower income level is like 39 single, 77 joint. Well, I have to check the rates. I don't have it on the slides. If an owner avoids paying sufficient qualified dividends, the IRS is entitled to assess a 20% accumulated earnings tax. The IRS knows that every investor that's sophisticated is going to want to put their investments into a C-Corp to get the lower rate and just let the money ride. But guess what? If they say you're an investment company and you retain $10, they can hit you with a 20% accumulated earnings tax. And you also might be a personal holding company and get another tax penalty. Historically, when they wrote these rules, going back this past century, half a century, there were at times a large gulf in the rates between a C-Corp and an individual. So they wrote all these rules. Well, a lot of that wasn't in focus over the past few dozen years because the gulf in the rates was not as great. You remember, by the way, that there were graduated C-Corp rates. The first 50,000 was only 15%. A lot of people ran their company, a small business, to break even. They'd pay salaries, take advantage of the 15% rate, still a low rate up to 75,000, and then they would accumulate earnings. This is a tax hike for them because it's a flat rate of 21%. It's a fallacy that owners can retain all earnings inside the C-Corp. I'm not going to spend too much time on the C-Corp because I already think I got the message through here. So starting in 2018 under the new tax law, C-Corps may benefit from a 21% flat tax rate versus individual graduated rates of 10 to 37%. So if you're in the 32% bracket, your average rate is pretty low. I mean, a flat tax rate could even be higher. So don't confuse the flat rate with your average rate. For example, the average individual tax rate is only 27% for a married couple when they first enter the 37% tax bracket. So if your income is $600,000 married, your average rate is 27%. That's only 6% more than the C-Corp rate. As soon as you have a little bit of double taxation, your savings is wiped out. For single, the difference is only 9%. So when you pay your qualified dividend, when C-Corps make a cash or property distribution, it's a qualified dividend. If you hold the stock more than 60 days, it's taxed at 0, 15, or 20%. So the here are the brackets. The 0% capital gains bracket applies to taxable income up to $77,200 married, $38,600 single. So if you have wages, you and your spouse, of more than that, you're in the 15% bracket. That 15% dividends tax right away wiped out that. Remember that benefit from the prior slide? It was 6% or 9%. Even at that high income level, you just wiped it out and paid more tax. Plus, you got to do the state double taxation. It ranges from 3% in North Carolina to 12% in Iowa. I give you the map from the Tax Foundation. Look at the map to see what the rate is in your state. States don't use lower capital gains rates, so if you get a qualified dividend in California, you're still paying super high rates. Could be 9% or more. This accumulated earnings tax, this is the leveler. If you get hit with this, you're going to be sorry. The C-Corp does not pay, if a C-Corp does not pay dividends and you retain too much earnings and profits in the eyes of the IRS, and there are rules about this, they're going to hit you with an accumulated earnings tax. They're trying to incentivize you to pay the double taxation. They let you retain $250,000, but if you're a personal service corporation, like an accounting firm, it's $150,000. Now, if you're an investment company, it's nothing. It's zero. The IRS treats you. Now, if the IRS treats a trader tax status trading company as an investment company, then it may assess 20% AET on all accumulated earnings. undermining the whole strategy. Now, I don't think a TTS trading company with 475 ordinary income is an investment company. But do you want to be the guinea pig that has the first fight with the IRS on this? I don't know if they're going to recognize trader tax status in the C-Corp. A TTS trading C-Corp needs to demonstrate a business need for earnings over the 250,000 threshold. So let's say you say, okay, I'm a trading company, IRS, with TTS and 475. You can't hit me with AET on the first 250. I'm allowed to keep 250. Anything above 250, I have to have a war chest plan on why I need that money. All of big corporate America, of course they're over 250, but they have war chest plans. They have board-approved plans that are feasible, that they work on with their accountants and lawyers for why they need to retain earnings. And I have this in the blog post about it, like if you want to buy a seat leased or hire more people, to just say you need more margin or for better commissions, or you need more working capital for more growth, that does not cut the mustard on a war chest plan. So you see, there's a lot of potential problems. Read my blog post on the C-Corp. And there's more problems as well. You can't pass through the losses, no 60-40. No investment expenses are allowed for an investment C-Corp. Zero. Plus, it could be a personal holding company tax. If you have personal holding company status, it's triggered when a closely held C-Corp has at least 60% of gross income coming from certain passive income, including interest, dividends, rents, royalties. They don't mention capital gains. That's good. If you have 60% or more of passive income, the IRS will hit you with a 20% PHC tax penalty. Capital gains and 475 ordinary income is not passive income. So if you're a very successful trader, yeah, you'll avoid the PHC tax, but suppose you have a losing year. You're going to trigger PHC tax penalty. All right, we're coming up to the last section, but this is an important one. So we're going to go a little late on the 1 hour because it's 12:57. Individual deductions. So by the way, so far, here's where we stand. Investor, no investment expenses, you want trader tax status. We went through the investor stuff. Pass-through, you have an investment in any kind of pass-through, you want to get that 20% deduction. C-Corp, you were interested? I just got you disinterested. Now, you lost a lot of deductions. What can you do about it? Is there anything that you can do? State and local taxes first. They're capped at $10,000 per year. You're sitting in Connecticut like I am right now, or on weekends I'm in New York City. You're in California. You're in a high tax state. You're upset. My trader clients have been real busy calling me this past few months. I've been booked solid. And they're ready to move. They can move. They're traders. They don't have a job. They can move to Nevada, Texas, Florida, Tennessee. They can go to a non-tax state and stop paying these heavy state taxes. And now they can't even deduct a lot of those state taxes because they're capped at $10,000 a year. They're burning mad. The Act allows any combination of state and local income, sales, or domestic property tax, SALT, does not include foreign real property tax. The Act prohibits, so you're capped at $10,000 a year. In Connecticut, your real estate taxes alone could be over $10,000. Then you got your income taxes. I mean, you're losing a lot. So a lot of people went into year end saying, I'm just going to prepay my fourth quarter estimated income tax and pay a boatload extra to sneak in the 018. That's not allowed. I'm going to do the same thing with my property tax. I'm going to pay next year's early. That's not allowed. If you got a property tax bill that said, it's July 1st, 2017 to June 30th, 2018, and you got the bill from your tax authority in December and you paid the whole thing. You used to pay it quarterly, now you pay the whole thing. That was allowed. There's an IRS notice about that. You're going to get the slides in the download, so read over this later. Now, suppose you're a trading business and you have a home office deduction. That's great because you're going to get some of your SALT on Schedule C above the $10,000 cap. So take advantage of the home office deduction. That gives you some above the cap. Your medical expenses were modified. It used to be they were going to make the AGI limit much higher. They were going to not allow it at all. Thanks to Senator Susan Collins, they came in with the Senate and they fixed it all. And you're going to get the 7.5% AGI threshold for 2018 and the 10% for everybody next year. So for the 1 year, 7.5%, and for next year, the 10%. It still is an AMT preference, and there still is AMT tax, but the thresholds are higher. So they modified this in a better way. They were going to really hurt people with this, like deducting the nursing home or the continuing care facilities. But this came out a lot better. So read the fine print. The mortgage debt that was lowered on the new loans, you could be grandfathered. So as of December 15th, if you have a new acquisition indebtedness, it's limited to $750. That's on your first and second home. So remember, there was the House bill, the Senate bill. These rules were much worse. They backed off a little bit. They made it a little bit better. So they kind of they met halfway at $750, not $500, not $1 million. So it's down from $1 million to $750 on new debt, primary and secondary. Now, by the way, if you have a home equity loan, gone. The conference report suspends the deduction for interest on home equity indebtedness. There's nothing grandfathered here. So if you've been using a HELOC, a home equity loan, to consolidate other debt, because it used to be you were allowed up to $100,000 on that. All that interest is not deductible. So you can refinance old debt. So the mortgage debt incurred before December 15th is subject to the grandfathered $1 million limit. Refinancing debt from before 12/15 keeps the grandfathered limit. So you had a $900,000 mortgage on your first and second home. That's a lot of money, folks. But you know, in Connecticut, it's not really, although the prices of houses are going down. But if you're refinancing that debt, you still keep that old grandfathered limit. But if you go to the bank and say, I want to refinance 800, hey, throw on another 50 for me. That other 50 you won't get. So read the fine print. Now, let's say you're working for a bank or a brokerage firm. You work for Interactive Brokers, and you have unreimbursed employee expenses. Those are, you remember when I said they wiped out all miscellaneous deductions? Well, that included your unreimbursed employee expenses. So that was on Form 2106. So you want to speak with your employer about implementing an accountable plan. They probably have it, but if they don't, they should implement it. And you want to use it or lose it before year end 2018. That's what our S-Corp traders do too. They have an accountable reimbursement plan. So you want to make sure that you get reimbursed for these items so you don't have to try to deduct it on your tax return, because that deduction it's not there anymore. Same for the tax preparation and planning fees. Remember that the Senate did this very simply. They said, no more miscellaneous itemized deductions. If you go back and read my blog post on this section, it's on the website, about the deductions that were lost, I go through that whole list. It's long. It's all gone. Now, one of the areas is the tax compliance, paying off firm to prepare your tax returns. But if we do your business return and your individual, most of our costs could relate to the business and be deductible as a business expense. So remember, you're trying to find a business purpose so you can have deductions on the one hand, and you can get a 20% QBI deduction on the other hand, or maybe the C-Corp can work for you because it's not a big income C-Corp and you can retain some earnings. That's the name of the game, business. If you have a personal casualty or theft loss, it's suspended. So the personal casualty and theft loss itemized deduction, except for losses incurred in a federal declared disaster area. So if Hurricane Irma, Maria, you are getting a much better benefit there. It's on our website and exactly how it works. If you get reimbursement, you're going to have to square up on that as well. if you have gains from the insurance company. If you're a gambler, the Act added gambling expenses to the gambling losses and applying the limit against gambling winnings. It used to be professional gamblers. Their losses were limited to winnings, but they could have their expenses on a Schedule C. That's now limited to the winnings as well. Charitable contribution deduction limitation is increased. So it raised it from 50% to 60%. Excess contributions are carried over with a higher standard deduction, because you remember the standard deduction was increased, and the suspension of many itemized deductions. Some taxpayers won't feel the deduction effect from charitable contributions. Your SALT is limited to 10. Your mortgage, let's say, is you paid off your mortgage. Or let's say your mortgage is, 10, it's 20,000. Your standard deduction, you're married, is 24 and change, or 24. So you're going to use the standard deduction. You may say, I don't want to make charity this year because the first 1,000 or 2 I make, I'm not even going to feel the benefit. So I'll use a bunching strategy. I'll double up this year, make sure I'm itemizing. And next year, when I pay down my mortgage more and have less mortgage interest, then I won't have any charitable deduction. I'll double up this year. Or you do another strategy like a charitable trust. You set up a charitable trust, you contribute $100,000, you get a whopping big deduction, and then you give the money from that trust to a charity each year over time. The Act suspends alimony deductions for divorce or separation agreements executed in 2019. Recipient doesn't have taxable income. Suspends AGI deduction for moving expenses. Employees may no longer exclude moving expense reimbursements. Is an exception for armed forces. Go back and read the blog post on this. It goes through all the details about all the individual changes, about the rates, the standard deduction, the child care, the works. It expanded the use of 529 education accounts. So it used to be very limited. Now your qualified higher education expense can include tuition on elementary or secondary, public, private, or religious school. Traders could really set up these accounts, invest them properly, and use them in a much greater way. That's a nice benefit. So let's go to closing remarks. We're only 7 minutes over. Now, so get your questions on the board. We're going to get to some of those, maybe not all of them, and I'll try not to answer multiple questions from the same person to start. We'll see how we're doing on timing. Come over to GreenTraderTax.com. We had to upgrade our site last night. Our traffic is exploding, so we had to upgrade our cloud service. So you may see a glitch here or there today in that upgrade. That's a good problem to have. We want to make sure that our pages are super fast and served up because you want your information, and we have it on our site. Give us a call, speak to Julie in customer support, chat with us. Send us your questions to info@greentradertax.com. So come over to the website. That's a PowerPoint page of it. Let me open up the site. So for those of you not familiar with Green Trader Tax, come over to the site. You have the blogs and the events. You'll see this past year that all the events have been through Interactive Brokers. You can get the recordings on the IB site. You can access them from our site. So go to events and recordings. Just hit this button on the sticky nav, events, or right down here below, events and recordings, recent blog posts. Remember how traders can get the 20% QBI deduction, how to decide if a C-Corp is right for your trading business. The tax cut suspended many deductions for individuals. The tax cut impacts investors in negative, positive ways. Read all those posts. But definitely get the guide, folks. It's fantastic. I put a lot of work into it. It really came out great. You get the download immediately, and then the paperback, if you want that version, comes like in 10 to 12 days. Then check out all the Trader Tax Center. There's a lot of information here. It's excerpted from the guide. And then check out the services. So let's go now to your questions. Let me just drink a little water as I bring that up. Cynthia, do you see the questions?
Yes, I am seeing the questions. And Robert, in your control panel, you'll find there is a sharing field. If you click the sharing field, you can pause sharing so that you can go in and read those questions. There are quite a few that have come in.
So it shows my screens. I'm not going to stop. You want me to stop the sharing screen, you're saying?
No, if you click on screen share again, it will pause it so that you can read the questions, so that you can open up the questions.
So you want me to stop screen sharing or hit the pause button?
Just hit the pause button.
All right. Did that do it?
Now you can open up those questions.
All right, I had already. Now,
now we see just
the
your,
website.
the
Great.
website, right.
Good. Great. All right. Yeah, we like to not show the questions because some people may not want their full names. I'm sorry, it was shown there for a few seconds there. So I don't know if you can edit that out on the recording, Cynthia, when it was up for a few seconds. Okay, let's go.
That part got in the recording, so we're good.
Okay.
So far, we're good. And now you should be able to read them.
Okay, good. Let me just take just a few seconds break. All right. So we have the first batch is just that the sound was good. All right. So from BG, I'm just going to say initials. Is it a 20% deduction on pass-through income or a 20% tax rate? It's a deduction. It's on the lower of QBI or taxable income less capital gains. So you make 100, you're single, you make 100,000 trading all 475. That's the only income you have. Take your itemized deduction, and let's say your trading gains were 112,000. You take your itemized deduction, you get down to 100,000 of taxable income. Your trading gains were 112. The deduction's on the 100 because it's on the lower of your taxable income less capital gains. It's real confusing. So keep on top of our content. BT or just Brian. If I am an investor, so no trader tax status, and carrying a significant capital loss carryover from 017 to 018, what happens to your loss? The whole thing can be soaked up with capital gains. You carry over 100,000, you make 150, you soak up the whole thing. The 3,000 limited is only net. Read my guide. The whole chapter 2 is on 475, and I go through all those capital gains questions so that you don't feel like you're going to be disenfranchised from it if you set up a pass-through entity, because the pass-through entity can pass through capital gains. So you'd want to stay in capital gains treatment. You would not want to rush into 475 ordinary income to get the 20% QBI deduction, because you would rather that the taxable gains be tax-free to be offset with capital loss carryovers. That's why in the end, you may want to consult with me, because there's so many moving parts that's what I do in the consultation, is boil it down so we don't miss any of these issues. Jacob M. According to my tax advisor, stock borrow fees are deducted as interest expense. Wrong. Absolutely wrong. You got to read my blog post. I tackle that fully. Your borrow fees are investment expenses. Interest expense is margin interest. There's got to be a loan of money. I cover this. We had our attorney involved. Read the blog post about that. So just go over to the website. You can go to the blog and just hit, control find and find borrow fees, and presto, it's right there. So read those blog posts. There's a lot of confusion on that, and it takes on more importance than ever right now. You'll see the lawyer that we talk about that on, and we'll do maybe a webinar on that soon. For an investor who does not qualify, can investment expenses, I'm not going to get into, Jacob, this is your second question, offshore PIFIC. That's beyond the scope of today's presentation. But for your short seller, you want the trader tax status, so the borrow fee is a business expense. So I'm going to try to get one round of questions before I do the multiple ones. Vishal G, what are the alternatives if I cannot qualify myself for TTS as a result of a job income? You can have a job and still qualify, but maybe you feel that you just can't put in enough hours or enough trades and you don't qualify. Well, you're an investor. So if you're an investor and you don't have any deductions for your expenses, keep your expenses low. There's a lot of information on IB's website and other brokers' websites. There's a lot of tools out there. Keep your expenses low because you're not going to get a deduction. Think more about trading 1256 contracts with lower 60/40 tax rates. You get that great benefit. Trade more in your retirement accounts to grow that. If you don't have TTS, don't step on the gas to create the status. You may not have a lot riding on the line anyway. If you have a job, you have your health insurance and retirement plan probably there, so you don't need the trading entity for that. So I go through this in the consultations. K for, okay, that was a question for Cynthia. David B, small trader 50K account, which is better, LLC or C-Corp? It's probably not the C-Corp. I mean, I do have an example in my blog post about a high-income trader in Texas that maybe the C-Corp can work for because there's no corporate tax, no individual tax, and they probably won't trigger the 0.75% franchise tax, which doesn't really kick in until you make $1.4 million or change. So I give a good example there. Tommy L, if you're a TTS MTM election 475 and you have realized gains, well, MTM anyway, that are more than 1 year, yes, you can segregate your investment positions. You can elect, you ring fence your trading into an entity, elect 475 on that, keep your investments individually, and you can still buy and hold those and have deferral at year end and long-term capital gains. It's better with the ring fencing of the entity. You can technically elect 475 individually by this April 17th for 2018. But if you hyperactively trade Apple, but also invest in Apple and with portfolio margining, you're going to give the IRS a chance to kick a loss out of 475 or grab a gain from investments into 475, disenfranchising you from a long-term capital gain. So I think if you invest in the same things that you trade, it's very important to ring fence the trading into an entity. Jim T, under the new law, add sales tax paid to income tax. Yeah, I believe it's included in SALT because there are some states that don't have income but have sales tax. So I have that in the slides, but I'd have to double check. I think I said it's income, sales, and property, but not foreign real estate. Hermont B, taxable income threshold married is 315, right? And then the 100K phase out above that. MR, does an LLC electing to be taxed as S-Corp qualify employee benefit plan deductions? Exactly. That's exactly how it works. Yes, you need the S-Corp to pay the officer compensation, add the health insurance to the W-2, get the deduction on the individual return, and do the high deductible retirement plan. The partnership trader cannot do that. The S-Corp trader can. That's why you need the S-Corp for the cake, and then put yourself into a position with the 475 for the icing on the cake, the 20% deduction. DWT, you want a link? Well, just go to the website. You'll see everything linked from the homepage. Brian S, if you want to confirm that a TTS trader 475 income, well, the trading business is a specified service activity. That's our position. They seem to go out of their way to list trading in the definition. I mean, I did, in some of my blog posts, I was very picky about it. There are some people who don't think it's 100%, but I think it's pretty certain that it is a specified service activity, and it's pretty certain that it's 475 income, not capital gains. A lot of multiple questions. I'm just trying to get through the first round for people. Yes, there is a recording. JPP. Yeah, you'll get the slides and the recording. Takaya C, or T, if you paid your estimated tax 017, not a boatload extra. I mean, how's the IRS going to really rein that in? I mean, a lot of people pay Q4. They don't want an estimated tax penalty. You didn't want to just do the safe harbor. You wanted to pay what you owed by 1231 to get a deduction before SALT was capped. How do you know exactly what you owed with wash sales, with K1s from partnerships? You don't know exactly. You did a good faith estimate. You paid high. I think that's reasonable, but if you went just way, way overboard. So that's going to be tricky to monitor. There's a lot of work for the IRS in this new act. Wow, is there a lot of work. And they don't have the funding. And with government shutdowns here or there, they're thrown for a loop. I mean, how's the IRS going to do all this? This is like when they added Obamacare. They didn't get rid of AMT. They didn't get rid of Obamacare. We're still stuck with all the old tax regimes, and now they added a whole new one with the qualified business deduction, income deduction. So it's another employment act for accountants. And now we're working for the states, too, to make a state and local tax deduction. The states are trying to have you pay charity or through employment taxes so that it's a deduction and it's not limited through SALT. So that's going to be another saga. The states are going to definitely have their turn. So this thing is going to be a patent place for the people who remember that show. That's going way back, old school. But it's in the lexicon. I mean, a lot of drama. Michael S. Again, PDF. Jake M. What would you recommend for a small futures trader? Okay, great concept, all right? So there are some times, you remember I said, I want you to go for your cake and put yourself in position for the icing too. That's great, cake and icing too. But there are some times when you have to make a choice. You're a Forex trader with 988 ordinary income. That's qualified business income. If you make a capital gains election for Section 1256G, lower 60/40 tax rates on the majors only, which is not 100% certain, getting lower 60/40 tax rates is fantastic. If you're high income and you know you're not getting the 20% QBI, why stay in 988 ordinary? Go for 1256 60/40. But if you're low income, should you stay with ordinary loss treatment, which is good, and now ordinary gain treatment, which is good? Well, that's a tricky decision. You have to think it out. So that's one you make with me. Now, your futures trader, you could elect 1250, 475, but then you'd give up 60/40. I don't think you should. I think you should stay with 60/40. And you want your carried interest to get your profit allocation because you then get a share of 60/40 instead of incentive fee income. And then your investors won't get a deduction for paying your incentive fee. So if you're an investment manager, you're a trader, you want to talk to me to sort all this out. It's not a slam dunk easy decision on your own. Why wouldn't you want my help? I raised my 30-minute to 45s because every one of my 30s were going over. My schedule got too crowded with 30s. Then I was late for meetings because I didn't want to cut people short, and I went over. So I changed it to 45 minutes. We need the 45. We're going to go over that. And then you can book me every hour on the hour. But it may go out a week or two. Craig N. If trading in a retirement account, say you avoid NIT, yeah, it's a good idea. Brooke D. Again, the slides. IGG. Does a second mortgage qualify? Yeah, but not the home equity. So you remember, this thing got extra complicated because we had the House bill. And then that went through changes. Then we had the Senate bill. And that went through changes. Then we had the conference agreement. And then that was changed last minute. So whenever you happen to do a reading of what the law was going to be, you got super confused. This was in, this was out, it was crazy. And I was writing about it the whole time because I figured I had to keep the clients informed, but then I had to cancel all my vacation plans, and I spent the whole time updating all the clients on what the final rules are, and this is the final stuff. So you got to wipe the slate clean of the old stuff that was changed and understand the final stuff. Next question, Robert G. And it makes a lot of sense the way they made the final stuff. And they mostly went with the Senate bill on a lot of stuff, especially on the pass-through, because the House bill was absolutely crazy. It didn't make any sense. You know, you think that there's a lot of people behind the scenes working on all this stuff, but when you read some of the books, popular books out there now, I don't want to mention names, it's shocking. Like when you pull the curtain on the Wizard of Oz, what's behind the curtain there? It's just sometimes a couple of people who don't know what the heck they're doing, just slapping stuff together. It's pretty scary. So don't think that there's a whole law firm back there working this stuff out. This stuff was done in haste, to say the least. Robert G. If a TTS S-Corp trader has no clients, how can that be a service business? Yeah, that's what I said too. Go back. I didn't post on Forbes when I said how traders should get these breaks, but I made some arguments that trading should not, a hedge fund is not a service business, on how everything should be QBI. I'm fighting for you. I'm not giving up on that, but I'm not advising clients on that aggressive posturing. I want them to take the more conservative bent until we see the IRS regulations, because I also know kind of some of the intent. So I'm not going to beat them up on a comma misplacement here or there, but read my posts. I do there. I'll take you through that. Richard S.
Robert, before you get any further, how about 5 more minutes on questions, and then we will have to end the session. So,
good. Great
take
idea.
a few more to answer. Okay,
great.
Thanks.
Okay, thank you. I'm glad that Cynthia jumped in there because it can get way too long. I do encourage you to send me the questions at our firm, and we'll probably suggest you do a consult, but I may give you a quick answer here or there. Richard S. has a futures carryback. You can still do a carryback. That was not changed in the law. Steve R. If I earn 500K wages, have rental income. So you may be over the threshold. I think, Cynthia, there's just so many questions. You're absolutely right about that. I think we'll probably just wrap up now because I don't want to promise too many answers and not deliver now. So everyone, thank you for coming. I'm sorry we couldn't stay too late to answer all your questions. Send them over to our firm. I will answer emails over the next half hour to an hour with quick little answers here or there, but probably recommend a consult as well. So let me just do this quickly. Let me close the questions, show my screen, and I'll pass back to you, Cynthia, for wrapping up.
Okay. Well, Robert, thank you so much for all of your the wealth of information you've been able to provide. And I want to thank everyone who's attended today's session for sticking with us this long as well. Now, by the way, we have been recording, and you'll get access to direct access to the link so that you can come back and review the concepts that Robert discussed. Plus, I also have the slides will be included in the follow-up messages. There is a link to his webinar notes. So do want you to know that you'll be getting access to all of this information. But that does bring us to the conclusion of today's event. Once again, thanks so much to Robert Green of GreenTraderTax for today's presentation. And we're working with Robert, so please do check our webinars. There's a webinar section in the upper right-hand corner of the Interactive Broker website where we'll be posting any of our upcoming webinars. I heard him have several ideas today. So I do want to point you out there for not only upcoming, but also you'll find quite a wealth of additional webinars that he's already provided. So with that, we will end today's session. You can exit using the X in the upper right-hand corner of the screen. Many thanks again to all of you for participating. Have a great day, everyone, and please all do trade smart. Thanks, everybody. Have a good one.